Okay, thanks, David. Appreciate the opportunity to come out and talk to everybody. We're going to focus on a couple things today. Obviously, the theme is trader psychology. One way that I've found to manage my emotions is to use option spreads as opposed to trading futures outright. And so we're going to talk about that today. And sometimes, when people think of option spreads, sometimes they think limited risk or low risk. That's not necessarily true. It depends on how you structure your trade. You can structure a very aggressive option trade and still give yourself a lot of room for error and take some of the mental anguish out of it. So we're going to talk about that. Before we get into the options, I'm just going to give you a couple primers on trader psychology, things like that. And afterwards, I'll give you some pointers as well. My name is Carley Garner. I'm a futures and options broker. We run a boutique brokerage shop, commodity brokerage. So we deal in futures and options on futures. We don't deal on stocks or ETFs. We stick to commodities. If you have any questions or you want to get a hold of me, there's my contact information. I'd love to see you on social media. We're on Twitter, Facebook, Instagram, YouTube. I post a lot of dog pictures. I'm here in Las Vegas. If I didn't mention that, this is my beagle, Frankie. And this is fabulous Las Vegas. So just a little background. I am a broker. I already mentioned that. I'm also an author. I write a monthly column for Stocks and Commodities magazine. I write a couple of newsletters for our brokerage clients that include commentary, opinions, projections, and trading ideas. And I also contribute to Jim Cramer's Mad Money as well as Bloomberg Television. In fact, I was just on Bloomberg talking about an option trade that we're going to go over today about an hour ago. I've written several books. If you are interested in learning more and you go to Amazon, ignore everything else. These are the only three you need to pay attention to. The others are older publishers, older content. This is the new, fresh content, updated information. And one last thing, if you're you can sign up for a free trial of our newsletters on our website, which is decarleytrading.com. I'll show that web address again at the end of the presentation. But you can always download our mobile app. If you go to your app store and search for DeCarley Trading, you'll see our app. And that also will allow you to sign up for a trial of our newsletters. So before I get going, just want to make sure that everyone understands there's a substantial risk of loss in trading futures and options. It's not suitable for everybody. And I always add, it's probably not suitable for most people. For most people, it's just not for them. Let's just put it that way. It's a really tough game. Commodities aren't like stocks that generally go up throughout history. So they're a lot more forgiving. Stocks pay dividends, commodities don't. And commodities generally go down more than they go up, believe it or not. It's hard to believe in an environment like we're in now, where commodities are skyrocketing. But the reality is, if you look at a really big, I should say a very long-term chart of commodities, they have a hard time holding rallies. Speculating is easy, trading is not. Trading is 95% emotional. This is a quote that I try to keep in mind throughout, as the markets are ebbing and flowing. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. And I can honestly tell you this is true. There are people that have doctorate degrees that are insanely smart, but they just can't figure out how to make money in the markets. And there are people that probably dropped out of high school, but they've figured out the market. So it has nothing to do with intelligence or education. It really is emotional management. I've seen two traders given the exact same signals, the exact same recommendations, and one wins and one loses on the trade. And the difference is panic liquidation, position sizing, or some other mental aspect of the game. Emotion is probably the most influential factor in trader success or failure. And it has to do with the inability to keep fear and greed at bay. These two emotions, I mean, I know you've probably heard fear and greed talked about a million times today. The reality is, those are the two things that will hold you back and possibly even devastate your trading account. That's just how it is. We're all human. We all have the same challenges. We all kind of think the same. We're all wired the same in regards to how we react to adverse situations or even success. We tend to be too complacent when things are going well, and we tend to be too fearful when things are going not so well. There's a quote that I have hanging over my desk that says, "You are never as smart as you think you are when you're winning, and you're never as dumb as you think you are when you're losing." And that's absolutely true. So the key is try to keep yourself somewhere in the middle, stay grounded. I know it's not easy. It's a lot easier to say these things than to actually practice them in real time, right? So the one thing I like to point out is I get a lot of people that contact me and they make market calls and they say, crude oil's a buy here. And then 3 months later, they reach out to me again and say, "I told you it was a buy. It's up $30 from where it was when I told you it was a buy." But somebody that does that is probably not trading it. They probably didn't buy oil. They probably just tweeted and told me this is the time to buy. The point is, when you're paper trading, when you have no money on the line, it's not, it's a lot easier to predict market price because you don't have to worry about getting stopped out. You don't have to worry about losing sleep if you're a little early or a little late. Paper trading has nothing to do with profitable trading. It's an illusion. Just recently, I was at the money show here in Las Vegas, and somebody came up to me bragging about how they're up, I can't remember the number, but something 2,000-3,000% in their paper trading account. And I probably wasn't as impressed as he was with himself, because I've seen this before. Paper trading is so much easier than real trading because there's mulligans, and again, doesn't stress you out when you get stopped out, or if you're losing, you can get out without thinking about it twice, and you can let your winners run because it's not real money. There's a big difference between being right and making money. Even if you accurately predict a bull or bear market, the trades that you implement may or may not actually make money. And this is where new traders get really, really frustrated. For example, if you're an option buyer, you might get hurt by time value. Maybe you bought a call option, the market went up, but didn't go up enough for your option to actually gain value. Option sellers, and I see this a lot, option selling has been a rough strategy over the last year or so, just because the volatility has been very explosive. That said, it's probably about the best opportunity to be an option seller as well, because the premiums are fat. So as long as you didn't have positions on when things were quiet and then became volatile, you might be doing pretty good. That said, what happens to option sellers is they're usually pushing their limits. They're usually over leveraged, using too much margin, and they get forced out of positions due to volatility prematurely. So they might have been right on their direction or right on their prediction. Their strategy might not have been that horrible, but they still ran out of margin. That happens, unfortunately, more than I'd like to think about. And of course, there's the panic liquidation, premature liquidation. Anyone following gold and silver saw that in real time a week or two ago. Silver was down, I believe, off the top of my head, I think 16 days in a row. I don't think I've ever seen silver sell off for 16 days in a row. So that was super extraordinary. And then I think it was down 17 of 18 trading sessions at that time as well. So there was some really unusual panic liquidation going on in metals a few weeks ago, which is unfortunate. So we'll see how it goes. I personally think metals have probably bottomed, but only time will tell. It'll be sad for anybody that got knocked out on the lows and then have to watch the market go without them. One thing that might help you is to always assume that you're wrong, and never just assume that your analysis is going to pay off, because the reality is, no matter how smart we think we are or how much work we've done, we can't tell the future. Sometimes there's unexpected news events. Sometimes we're just flat out wrong. Sometimes markets move in a manner that has nothing to do with fundamentals or charts or anything that we could possibly predict. Sometimes it's really just sheer emotion. We saw that in the treasury market this year. Even if you were bearish treasuries, you probably didn't think we'd see that big of a move that fast, simply because it's never happened before. So sometimes markets get out of control, and it has nothing to do with, again, fundamentals. It is what it is. Trading is a mental game, partly of wits, but mostly of emotional stability. I look at trading as something as being a doctor. Not everybody, or a nurse, let's say the medical profession, not everybody is equipped to handle the sight of blood. Not everybody is capable of absorbing the stresses of trading. Markets are mean. There's no other way to describe them. That's the best word I've found. If you trade long enough, regardless of how experienced you are and what you think you can and can't do, the market will probably make you cry. I've seen it more and more. I don't know if anyone is familiar with optionsellers.com. I think it was 2018, fall of 2018, they were a managed futures service that had been around for a long time, well respected, and they made some mistakes. And they're infamous for a YouTube video in which the head trader is on YouTube crying, and he obviously was remorseful for the money that he lost for himself and his clients, but it was a good reminder to all of us in the industry that anything can happen at any time, and risk management is always key. So before you enter a position in the market, you should always assess where major areas of support and resistance are. If you're placing stops or using options to hedge, you should determine what your hypothetical worst case scenario is. And I say hypothetical because the reality is we have no idea what the worst case scenario is. Even if you place a stop loss order, there's no guarantee that at some point the market doesn't hop over your stop. For example, if from a Friday close to a Sunday night open, the market makes a big jump one way or the other, it's possible it hops right over your stop loss and you have no stop at all. So there is no way to know what the exact worst case scenario is. But if we look at a chart, we can get an idea of what the likely worst case scenario would be. And if the thought of the worst case scenario or what you calculate it to be turns your stomach, that trade's probably not for you. You're probably putting yourself under undue stress. You're going to make bad decisions, and it could even trigger destructive behavior, revenge trading, too big of a position size, lack of patience. Any of those things will do damage to a trading account pretty quickly. So unfortunately, we're not all born with the ability to stay calm in bad times and humble in good times. This is a skill that's difficult to acquire, regardless of how many books you read on the topic or courses you take. You're really, hopefully you're born with it, but most of us aren't. You can partially learn it through experience, but you can't really control the markets, obviously. You can't always control your emotions, although again, experience, practice makes almost perfect, not quite perfect, but experience helps. But the idea is you can control your own environment. So in my opinion, a way to control the environment, or a way to push my emotions to the side, at least not always, but in normal market conditions, is to use options and option spread. So let's talk about how that might be a possibility. Options aren't for everybody. Option trading is not perfect. It doesn't fix all problems. There's still risk. You still have to be kind of right. But there's some strategies that you can partake in that will give you more room for error. You don't have to worry about being stopped out. You don't have to worry about being perfect. And so for me, it's helpful on the mental side of things. I believe you should look at options as building blocks. There's calls and puts, obviously, but you can put together various arrangements of calls and puts to create any type of strategy and risk reward that you want. So if you're creative, you can do some pretty incredible things with options. I don't have time, unfortunately, to go through all the details of options, but we'll just keep it real simple. Option buyers, if you're buying an option, if you're buying a call or buying a put, you have limited risk. You can't lose more than what you pay for the option, unless it gets exercised, but let's not even go there at this point. If you're an option seller, you have unlimited risk and limited profit potential. So I should have mentioned as an option buyer, you have unlimited profit potential. If you use a spread where you're buying and selling different options, you're kind of getting the best of both worlds. On the surface, a lot of people will assume that buying options is the only way to go and it's the best way to go. And maybe it is for some people. Just like anything else, options require that you fit the strategy with your personality. So some people like buying options because they know they can't lose more than what they pay for it and they have unlimited profit potential. So if the market runs, they're there for it. If it goes the other way, they know how much they had at risk, and that's that. The problem with buying options is they're eroding assets. And if you do buy options, your timing has to be pretty good. So does your direction. So there's not a lot of room for error. In other words, option buyers are gaining peace of mind, but giving up probability of success. Most options are priced to lose. Most options will slowly erode over time and probably expire worthless. So with that in mind, an option seller is already working with favorable odds. Option sellers can be wrong and still make money through time value erosion. Now, keep in mind, option sellers have limited profit potential. They can only make what they collect in premium, and they can lose an unlimited amount of money. So they're taking the opposite side of an option buyer. Option selling will work almost all the time, but there's going to be low probability black swan events that can truly ruin a trading account pretty quickly. So you have to be very careful. If you are selling options, you're going to want to be quick to hedge if necessary. And that might be buying futures contracts against short calls, selling futures against short puts. And keep in mind, there are many in micro contracts, so you can do delta neutral your trade. For example, if you're short a crude oil call with a delta of 20, you can buy 2 micro futures against it and get delta neutral. So that way you do still theoretically have unlimited risk on the upside, but it's nicely hedged, at least in the short. Catastrophic losses don't occur. You can take some action to hedge that. So I believe option spreads are the best of both worlds because you can take advantage of the leverage that option buying provides, but you can also sell premium to take advantage of time value erosion. And any premium that you sell is also going to take some of the edge off of the erosion of the long option in your spread. So a combination of long and short options allows you to design a strategy that has the net advantages and disadvantages of both types of option trading. For the most part, option spreads can be used to reduce overall cash flow, meaning you're going to spend less out-of-pocket expense for an option trade. And in generally, they're usually slower or less risky than trading futures, but I hesitate to say that because it is possible to create an option spread that can be even more risky than futures if you're trading higher quantities and things like that. So be careful. The one thing that I teach people is pay attention to your delta. I know there's people out there that talk about the option Greeks and this and that, and they focus on the Greeks. I glance at the Greeks, but I really pay attention to delta. That's the one Greek that I check all the time. And delta is basically the rate of change in an option or option spread versus the rate of change in the underlying futures contract. So for example, an option that's at the money, meaning the strike price is exactly where the futures price currently is, that option has a delta of 50%. And what that means is if the futures market moves up a point, your option will move a half a point. the futures market moves 2 points, your option moves 1 point. If you're trading an out of the money option, your delta might be 25%. And that means if the futures market moves 4 points, your option is going to move 1 point. Delta is important because it helps you to understand how to hedge your short option risk if something goes wrong. So I'm going to switch applications here and show you some trades that we've recommended in our newsletters and give you an idea of what the risks and rewards are and how you might structure option spreads in this type of environment. So just give me a second here. Okay, so hopefully everybody can see my screen here. This is actually a web page. This is the Carley's perspective. It's a newsletter that we send to our clients. This is a trade that we sent to them yesterday. I truly regret not waiting another day to put this out, but all in all, it's fine. Natural gas had a really wild day today. I don't know if anyone was watching natural gas, but it was like a 60-cent range. So if you were trading natural gas futures and the market had a 60-cent range, that's a $6,000 move per one single futures contract, which sounds great if you're on the right side of it, right? But natural gas is not an easy ride. No matter, even if you are on the right side of it, there are really big dips and jives, and the ebbs and flows really are too much for a lot of retail traders to handle. And so there's a couple things to know about natural gas. If you're trading futures and you place a stop order, let's say you're trading futures and you feel like you need to have limited risk, which I don't blame you, especially in natural gas. If you place a stop order, the odds of you getting stopped out are probably 80–90% in most situations, unless you have a really deep stop. And in that case, your risk is several $1,000s. So it's really, really a tough market to play with futures. Here's a way to play it with options. Now, I'm not saying this is a low risk trade. In fact, when we put this out to our clients, we said, almost all of you should just paper trade this, not actually execute it in your accounts. That said, we wanted to give people an idea of how to manage this type of volatility. You can see on the left-hand side of the chart all these little tiny price bars. That's what natural gas usually looks like in a normal market. You get a little bit of volatility here, a little bit of volatility there, but it's relatively manageable. The last couple years, well, let's just say the last 8 months. The last 8 months have been completely unruly in natural gas. So it's just been a whole different ballgame. There's a couple reasons we think natural gas might be putting in a near-term top. Now, I'm not saying forever, but I'm saying for now. You can see on this chart, there's a bit of a triple top. And today was option expiration for the June natural gas options. Tomorrow is futures expiration for the June contract. It's very common for markets to squeeze in the direction of the trend going into expirations. And then once all the expirations are over and all the traders have done what they needed to do to exit their positions going into expiration, the market, more often than not always, but it usually just rolls over and goes the other way. So tomorrow could be a little bit crazy, but let's say a week from now, there's a good chance natural gas is heading the other way, at least temporarily. But to try to sell a futures contract against that would be really extremely stressful, or at least for me. And like I said, if you try to place stops, you're most likely going to get stopped out, and maybe even with a really big loss. So this is a way to play the downside in natural gas with quite a bit of room for error. The idea is we think natural gas is going down. So purchasing a $8 put, okay, right here, purchasing an $8 put, that's our moneymaker. That's what we think we're going to make money on. But to purchase that $8,000 put would cost roughly, let's see, about, according to these prices, these are yesterday's prices, it's a little different now, but that would cost roughly $12,000. So if you wanted to buy that put, you be my guest. You're more than welcome to spend $12,000 on an option that's, number one, probably going to erode, maybe even to zero. But number two, if natural gas continues higher, that $8 put's just going to go up in smoke pretty quickly. So you can spend more than you might have spent on your first car on that option, or you could sell premium around it to help pay for it. In this case, because the volatility is so high, it's possible to sell a $13 call and a $7 put to cover the expense of the $8 put. In fact, it actually covers more than what we pay for the $8 put. So you get a credit for this trade. Yesterday, we were getting a credit of about $1,200. Today, at one point, there was a credit of like $3,200, $3,300. So it can be really big, a really big premium collection strategy with a kicker. Because if you're right, and the market doesn't necessarily just trade sideways and run off premium, but if it actually rolls over and sells lower, you can make money on both the short call and the put spread. Something that catches my eye here is divergence in the chart. You can see natural gas is making a new high, and today it actually made a new high, but the RSI is not. Now, there's no guarantees in trading, but more often than not, when you see that sort of thing, it tells you that the buying momentum, although prices are moving sharply, the momentum is not necessarily following suit, and you could get a reversal. I'm going to scroll down to, by the way, this is the September natural gas futures chart along with the options. So this is what it looks like on an order ticket, just to give you an idea of how big these numbers are. The numbers aren't usually this big. Before all heck broke loose in natural gas, an at the money option was $2,000 or $3,000, not $12,000, $13,000, $14,000. That's pretty wild, but it is what it is. And if you're selling options to help you pay for your long options, then it takes a little bit of the heat off of it. Oops, didn't mean to do that. So to give you numbers here, the way that this works is we're buying the $8 put, we're selling the $7 put. That trade alone, it can be done at a debit, but we're also selling the call to pay for all this stuff. So once we do that, we get a credit of about $1,200. So again, this morning that credit was actually up to about $3,000. So it's been a tough 24 hours for this position, but if you think, you know, a drawdown of 2,000 or 3,000 on an option spread is painful, imagine being in the futures market. If you'd sold the futures short yesterday, you'd probably be down at some point today. You probably would have been down 5,000, 6,000, 7,000, depending on your entry. So while it wasn't necessarily comfortable, it would have been a lot more comfortable than simply selling the futures. So a few more details about this trade. And again, I'm not recommending you take this trade. This is just for educational purposes, so you can see why it might be worth considering option trading to reduce your stress, because you don't have to stare at every tick. You don't have to sweat. If natural gas goes up 10 cents, your option spread's probably not going to move much. Whereas if you were in the futures, 10 cents is $1,000. And nat gas moves 10 cents literally in the blink of an eye. So some more details about this trade. Yesterday it had 94 days to expiration. It expires on August 26th. The margin is a little under 12,000. So this is not for everybody. This is for somebody that has quite a bit of risk capital and also has the stomach to ride this thing out, because let me tell you, the risk is unlimited above $13. I don't think we'll see nat gas above $13 in the next 94 days. But it doesn't have to get above $13 for this trade to get stressful. If natural gas goes to $12, and it does so in a very volatile manner, the losses on that short 13 call are going to be pretty substantial. So you want to be real careful. And it might be necessary to defend it by buying futures against it. So at this point, the $13 call has a delta of about 14 or 15. If you were really nervous about that and things started moving higher, you could buy a mini nat gas future against it. The mini nat gas is 1/4 the size of a futures contract. So if you buy a mini against your short $13 call, you actually get relatively close to delta neutral on that part of the trade. So that's one way to kind of slow things down while you get an idea of what's happening and maybe decide whether you want to keep the trade or let it go. Someone's asking why not sell an iron condor to limit upside risk? Well, the reality is if you, I mean, you could do that. That's one way to do it, but the options are so expensive and the skew is such, it's skewed so much to the upside that you'd literally be spending so much money on your protective call that it just wouldn't be worth selling any option at all. Because even if your risk was limited, it would be limited to like 20 grand. So let's look at another trade. Whoops, sorry. So the natural gas trade we put out yesterday, this is a trade for May 18th. So it's a little bit stale, but just wanted to show you. And it actually worked out well. We advised the clients that took this to get out today, take some profits. Probably wasn't as profitable as we would have hoped it would have been, just simply because the volatility is so high. And the short September 11 put kind of cut into it. But the good news is it was a relatively low stress trade. We knew that we had plenty of room on the upside. Wheat has never traded above 13.50. So we sold a $15 call, or we recommended to our clients to sell the $15 call and then buy the $12, $11 put spread in September wheat, knowing that wheat had never been above $15. So again, there's no guarantees. Maybe this is the year that all heck breaks loose and we do go above 15, but it's not likely. The last time wheat was up in this general area around the $13 area, within a handful of months, it was trading at 7. Just to answer a quick question, somebody's asking, so usually options are less volatile than the futures? And yeah, that's exactly right, because an option, a futures contract has a delta of 1, meaning for every point the futures market goes up or down, your futures contracts makes or loses a point. An option delta is always going to be less than 1. So it's always going to be less than the futures contract. But what happens is some people try to trade deep out of the money options with low deltas, but they sell a lot of them. Like they sell 20, 30 contracts. Now that is more risky than just trading a futures outright. So it's not black and white. People can really get into trouble if they're trading higher quantities. Okay, so let's look at the math on this. So this is this was again a couple of weeks ago. We thought wheat might be topping out and going lower, and luckily it worked out and we were right on that particular case. Trust me, sometimes we're wrong, but this one worked out. So the moneymaker was to buy the 112 put, and then sell the, I'm sorry, not the 112, the $12 put, and then sell an $11 put to help pay for that. And then also sell the $15 call to also pay for this. This is the one we want to make money on. We want wheat to go below 12. Right now, wheat options are very expensive for the same reason natural gas options are expensive and crude oil. Things are wild. The Russian-Ukraine conflict has really thrown a wrench in commodities. But you could have bought the $12 put for, let's just round it up and say it's $1. So if you spend $1 on that put, that's $5,000. That's a lot of money for a wheat put. And I know wheat's volatile, so maybe it's worth it. I don't know. I'm too cheap to spend $5,000 on a single option. In more normal market conditions, that option's probably more like 20 cents, 30 cents. So 1,000 to 1,500. So you can see everything is dramatically overpriced. So instead of paying $5 grand for an option, we could sell the 11 put and the $15 call and collect roughly enough to pay for it. You see, we actually could execute this trade based on these prices at a very small credit. We're talking that's 1 7/8 if you're not familiar with the grains. So we're talking like $75 roughly. So you bring in $75, it's a free trade that covers your commissions. The word free is in reference to the cash outflow. You're selling more premium than you're paying. These two are worth more than the option you're buying. But it's not free in regards to risk. You're accepting risk above $15. And in fact, you have unlimited risk above $15. Remember, I just mentioned that wheat's never been above $15, but there's always going to be, eventually there's not going to be a never. Eventually it's going to happen. I don't think it's on this particular pass, but we'll see. Like I said, we already advise our clients to get out. Someone's asking what WPR is. That's Williams percent R. It's an indicator. It's a pretty quick oversold, overbought indicator. So just a few more stats on this trade. At the time we put it out, it was 100 days to expiration, 3,500 in margin. So this is a much more reasonable trade for smaller accounts as opposed to the nat gas margin, which was about 12,000. And in more normal times, you could do a trade like this in wheat for $1,000 margin, but this just isn't a normal time. The most you could make on this trade is about $5,000, and that's if you held all the way to expiration and wheat was below $11. I should have mentioned on that last position we looked at in natural gas. Whoops, I shouldn't have done that. The profit potential was about $11,000. So just to give you an idea, like that's real money. $11,000 is a lot of money for the nat gas trade. $5,000 on this wheat trade if you hold expiration. Now let me explain this. With options, you can only calculate profit and risk at expiration. Before expiration, it's impossible to determine what an option might be worth at any given point before expiration because there's time value built in. There's volatility, time, there's things that you just cannot predict. So we can only calculate profit and loss at expiration with certainty. We can make guesses before expiration. So I always put if held to expiration, but then I also always put this in there, not likely. It is very rare that I believe a trader should hold all the way to expiration. In fact, I think almost never should a trader hold to expiration simply because if you put a trade like this on that has 100 days to expiration, just because you're right in the near term, let's say you put it on and it goes your way and 2 weeks later, you're sitting on a profit. But in order for you to get the maximum profit, you have to hold another 2.5 months. Well, there's nothing that guarantees that 2.5 months from now, you're still going to be right. It's very possible. In fact, I would say more often than not, when traders refuse to take a quick profit because they're holding out for the maximum profit that occurs months down the road, they usually end up turning a winner into a loser. So it's always best, in my opinion, to take money off the table, take your risk off the table as opposed to holding all the way to expiration. And if you do hold all the way to the wire, you're probably not going to be as happy as you think you are, because sometimes the days before expiration or the day of expiration, markets make dramatic moves one way or the other. If it happens to go the other way, you're gonna feel bad about yourself. I mean, I've seen people, even the day of expiration, like the morning of expiration, people sitting on profits of 3, 4, 5,000 on an option spread. But in their mind, they're thinking, well, expiration is only 5 hours from now. If I wait 5 hours, my $3,000 is going to be $4,000. But what often happens is their 3,000 turns to 1,000 or maybe even nothing. Everything dries up and expires worthless. So greed is never good. So this trade we recommended on May 11th. And believe it or not, it actually made some money relatively quickly. Hopefully everybody got out of it. Anyone that we talked to, we tried to advise them to get out and take their money off the table. And if somebody was aggressive, they could have kind of put the same trade or similar trade on with adjusted strike prices a couple of times in and out and actually done fine. It's just been such a wildly volatile market. But this is a way of trading. If obviously, I assume most people are following the S&P. That's the most common market that people watch. And it has just been a complete mess in the last couple of weeks, but there's been some opportunities on both sides of the tape. Your timing has to be pretty good. And you have to be willing to stick your neck out there. But this is a way to do it without having to worry about being prematurely stopped out or without having to worry about being perfect. And in a market like this, 50 points in the S&P is kind of just noise. Like, it's literally that wild. If you're trying to do a 5-point stop or a 10-point stop, you're probably going to have a hard time. It's just too volatile for that. But if you do a 50 or 100-point stop, your risk is probably deeper than what most of you want to risk. So this is a way to get around premature stop outs and give yourself some room for error. So at the time, the S&P was trading at roughly 3950-ish, 3970, somewhere in there. And the idea would be to buy a call option, buy a 4100 call option. That's the moneymaker. That's where we are hoping we make our money. But instead of spending a fortune on it, we can sell a 4250 call and a 3600 put to pay for it. And we should be able to collect enough. I'll look at the numbers in a minute. I think it was a small debit, meaning we did have to pay for the trade, but we were able to collect enough premium to mostly cover the cost of that 41 call. I should mention, when you sell a call above a call, when you do a vertical spread like this, the most you can make is the space between the two options, right? Once you sell that 4250 call, the great thing is it helps you pay for your 4100 call, but it limits your upside potential. So if the market just took off to the upside, it's not going to benefit you beyond 4250. If it goes to 4900, too bad. You only made money from 4150 to 4250. But as the previous speaker mentioned, this is basically a bear market, or it hasn't proven itself to be anything otherwise yet. So I think it's probably better to have the mindset of base hits, not home runs. On the flip side, the risk on this trade, if you hold all the way to expiration, is below 3,600. So that's roughly 4,000, I'm sorry, not 4,000, 400 S&P points below the market. So you can be wrong by 400 points at expiration, still not really lose money. The only way to lose money is if you hold all the way to expiration, and at expiration, it's below 3,600. At that point, you have unlimited downside risk, which could get a little hairy. As mentioned before, you don't have to just sit there and take it. You can sell minis or micros against it and adjust your delta and kind of level things out so that you can let some time pass. Okay, so here are the numbers on that trade. We did pay about $4 to get in. That's $200, just to give you an idea. Hypothetically, it'd be about that price on May 11th. If you wanted to just buy the 4100 call outright, it would have cost you 86 points. 86 points is about 17, oops, my math is up, about $4,300. So again, I'm too cheap to pay $4,300 for an option. I'd rather sell premium around it to pay for it. If you have attempted to purchase a call option in this environment and the bottom falls out, which it's been doing often, you probably have experienced that call option loses value very quickly. So if we spend $4,300 and suddenly the S&P drops 50 to 75 points, you're probably looking at a $1,500 drawdown on that option in a very short order. So a way to cushion that a little bit is to do a vertical spread. The losses on the 36.75 will cushion losses on this one if the market drops. And this could get a little ugly, but in this particular environment, the VIX is elevated. So if you wait to do this type of a trade when the VIX is in the 30s, somewhere between 33, maybe 35 if you're real lucky, then you'll notice that the downside doesn't really pump up this option a whole lot, or at least it's bearable, unless the VIX really starts getting out of control because it's so far out of the money. I should also say, this type of a strategy in this type of an environment in the S&P, you should be looking for quick profits. If you do decide to do this sort of thing and the market moves in your favor for a day or two, take the money and run. There's just no reason to have that unnecessary risk below the market. Because although I think we are probably going to find a temporary bottom around 3,800 if we haven't already, being long and wrong in this kind of environment can be very torturous. So be careful. Another thing I should also point out, with this type of a trade, if you get in and the market goes against you, let's say you get into this trade and the S&P drops to 3,900. As long as you still like the trade overall, you still think the S&P has a chance of going higher, instead of bailing on everything, and even before you decide to hedge the downside, one thing you could kind of do is get a little bit longer without taking hardly any more risk by buying back your short call. So if the market dropped and that short call that you collected $36 for is now worth $15, get it off the table, lock in your $1,000 on that leg. It hedged the other two legs that are probably nicely underwater. And if the market goes back up, you can resell it and get back into your original position. So I think being nimble and being creative can go a long way in this kind of a crazy environment. When this position was recommended, there were 37 days to expiration, the margin about 7,200. So it's a sizable margin. And again, the risk is unlimited below 3,600. The most you could make on this trade is 7,300. So I don't think that's really, I think that's pretty attractive for the margin versus the profit potential. But again, I just said, if it makes money in a couple of days, get out. And I still believe that. Don't try to target that $7,000 profit. If you can make $2,000 in a couple of days, by all means, take it and run. There's probably a good chance you'll get to put the exact same trade on or something similar a couple days down the road, because as we know, this market's been going both sides. Okay, we don't have a whole lot of time, but I'm just going to run through a couple quick mental tips to hopefully help you calm yourself. I'll say this one more time. Emotional stability is the difference between making and losing money. And trust me, I've been on both ends of it. So sometimes, unfortunately, you have to learn lessons the hard way, but understanding that is a step in the right direction. Nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances. It's not easy to do, but that is what we must do. So this is very obvious, but I'm going to say it. Before you sit down to analyze the markets or make trading decisions, take a few moments to relax, clear your thoughts, forget about anything else. Don't bring your personal life into the office with you when you're starting to look at the markets. Take a few breaths. If you're unable to relax and to get into a rational state of mind, walk away from the computer. And I shouldn't have to say this, but I'm going to, because I've heard so many stories of people drinking and trading. Don't do that. I mean, nothing good can come from that at all. When I say relax, I'm talking about maybe, breathing exercises, not a shot of tequila. One thing that I do that helps me a little is concentrate on the numbers, not the money. People work really hard for their money, and so losing it can be an emotional experience. So if you're focusing on your profit and loss, it's probably going to cause you stress. But if you look at your trades as a per point basis, so for example, if you're in the S&P, instead of looking at I'm making 100 or I'm losing 100, Look at points. I'm making a point, I'm making 3 points, I'm losing 3 points. Don't look at numbers, look at prices. And focus on percentages of probability, support, resistance, not money. So again, don't think about profits and losses. Think about, I think crude oil has resistance here. I think there's support here, and go from there. Don't worry about dollar amounts. Be confident. If you are not confident, then take a couple days off, take a couple weeks off, maybe even a month or two. You have to trust yourself and you have to trust the process, or bad things are going to happen. And you can also look at it this way. Trading is similar to a game of basketball. A basketball player goes through slumps, and so will a trader. There's going to be times where nothing you do is right. There's going to be times where everything you do is right. Traders that are lacking confidence might find that just simply after taking some time off, keep shooting. A basketball player has to shoot their way out of a slump. A trader has to do the same thing, but obviously a trader's dealing with real money and there's not an unlimited amount of money. So when I say keep shooting, I'm not saying at the same position size or the same risk you were before. Maybe use micros. If you were trading E-minis, maybe now trade micros. If you were trading 10 lots in options, maybe trade one. So keep shooting, but keep it small, build your confidence. And if once you feel comfortable again, then you can start increasing your size and getting back to where you were. But taking a step back and clearing things can do wonders. I still believe paper trading is a waste of time because it ignores emotions. So one way that you can paper trade but still keep some skin in the game is by using micro futures. There's micro currencies, gold. There are mini grains. There are also mini currencies. There are now micro crude oil futures and options. So this allows you to paper trade, but with some skin in the game, so that you do get a hint of what it might be like to actually make or lose real money in the markets. I'm not saying you should never paper trade, but I've talked to people that paper trade for years. They're like career paper traders. And I truly believe after a month or two, you're not doing yourself any good. In fact, you're probably hurting yourself because you're building too much confidence and too much complacency to fully recognize the risks of when you start trading with real money, you know, how things don't necessarily go as planned. Sound mind and body are a package deal. We should always work towards staying active. It stimulates brain chemicals. I know that sounds like it has nothing to do with trading, but trust me, if you're exercising and moving, and that might not even be cardio, we may be just going for a walk, it's going to make you feel happier and more relaxed. You're going to make better decisions, particularly if your sleeping habits are sufficient, 7 to 8 hours a day, eat right. Trust me, if you're sitting at a desk staring at the screen, eating Doritos, you're probably not going to be in the proper frame of mind to make good decisions. Not judging anyone that does that. I'm just saying we have to take care of our bodies, and if our bodies will hopefully take care of us, and that includes improving our mental capacity to handle adverse situations as well as positive situations. And one thing that I'm going to focus on at this point is do your homework, study the markets, pick your own trades. Don't subscribe to a guru or a signal provider's trades. You can. I shouldn't say that. I shouldn't say don't do it. I'm saying if you do, make sure you also confirm what they're telling you. Don't just blindly follow somebody else's ideas, even if they're good ideas. It's important that you understand that they're good ideas and that you trust the process and that you are comfortable, so that you don't make poor decisions if something goes wrong, or get upset if something, if you think if they made a bad decision, you can't blame other people. Make sure you do your own homework. Blindly following others leads to a false sense of security. It promotes complacency. And in my opinion, it opens the doors to excessive losses. So always confirm that you agree with the analysis before you actually put a trade on. People can be wrong. People that have been involved in the markets for decades can be wrong. Don't be afraid to trade very small contract sizes. Trade one lots, trade minis, trade micros. It's not saying anything negative about a trader if they're trading a very small size. I think people overestimate the need to trade multiple quantities. The idea is they want to get rich quick, or they think if they're trading a higher quantity of contracts, they're somehow going to make more money. And it's literally the opposite. It only takes $50 in profits every trading day to equate to $12,000 a year. And the reason I say that is most people that are trading, they're looking for much bigger profits than that. But the problem is if they're shooting for these huge profit figures and they're trading multiple contracts, by the time they balance out the winning days and the losing days, they're probably not coming ahead. The lower the quantity you trade, the less stress you're putting on your emotions, and probably the better you're going to do. So less is more. Also, if you're angry, if you're overwhelmed, if you're depressed, if you're obsessed, stop trading, walk away for a couple months. 2 months down the road, you won't even forget what was stressing you out. I'm sorry, you won't even remember what was stressing you out to begin with. Accept the fact that you're going to be wrong. Come to grips with the reality that putting the odds in your favor isn't always enough. I was reminded of this in wheat this year. We had recommended call ladders to our clients. We expected the market to go up. When it went up a little higher than we thought it was going to go, we bought futures against our naked calls so that we were fully hedged. And next thing you know, wheat was up limit 6 days in a row. And despite all of our attempts to do all the right things, we still got run over simply because the futures limit was 75 cents, but the options traded freely. So while our futures hedges were only allowed to go up 75 cents, the options were going up $2 or $3 a day. So no matter how perfect you think your strategy is, or how much homework or how right you are, sometimes things just don't work out. There's no holy grail. Being humble goes a long way. We're out of time here, so I'm going to skip to the end. If you're interested in learning more about the option trades that we went over, or at least those strategies, I should say, visit TradingCommodityOptions.com. There's quite a few excerpts from our book. If you're interested in the book, you can go to Amazon. I think it's $19.99 for the paperback, and if you want it on Kindle, it's a lot cheaper than that. This is what the book looks like. You'll see another book called Commodity Options that's with a black cover. Ignore that. Focus on this one. This is the newest version. And if you have any questions, comments, or concerns, here's my contact information. You can send me an email if there's anything I can do for you. Again, we're a boutique brokerage shop. We handle everything from full service to discount online. But the difference is we answer our phones, we answer our emails, we're experienced, and we provide trading ideas and commentary. Thanks again for your support.